So the financial accessibility, I think, is like an infrastructure problem. Where like if you can help connect people who are passionate and want to build companies that can or could or should or will change the world, there's a lot of money out there looking for exposure to that stuff. But you have to find a way to make those things compatible so that money can flow into early stage ventures. So something like Antler is a tool to help make that happen. Just like we raise money from investors, and then we go through and do the work of trying to find out what are early stage ventures that we can give money to.
What's a picture perfect investment for Antler? What does that look like?
Like when we make the investment?
The person, the company. Yeah.
I don't know. I think it's dangerous to answer that question because I think actually one of the really challenging things about being an investor is if you ever decide what a picture perfect investment looks like, you'll miss the next great investment. So it's like this constant process of building really strong beliefs and conviction and then exposing them until they break down and evolve into something else. And so I would say on the baseline, like from a team perspective, so the team is super passionate about what they're doing.
Where are they? Where's the team at so far in their product? They have monthly recurring revenue that they can prove?
I mean, we've worked with teams that don't have even a product, don't even have a pitch deck.
And how do they convince you to give them money?
Mostly based on what they've done before.
Okay, that's what you're saying, their track record.
Yeah, so it's like, well, tell me that you've done cool, exciting things before that were challenging and hard and you didn't give up and you fought through and you made things happen or whatever. And I can work off of that.
And what kind of investment would you give them? A runway type investment to where they can stop working and fund their project?
Yeah, so we usually write like $150 to $200K check.
Okay.
After work, so we would bring a founder in, give them a small amount of money up front to work. So say a founder comes and says, you know, she's super passionate about climate change. She's got a background in climate change. So she's credible. So something called like team product fit, I'm a big fan of, which is like, does it make sense that you're the right person to build this company? Or can I trust that you understand the space that you're going into to be competitive? A track record of action bias, right? So tell me, I don't care where you went to school. I don't care where you worked at, but tell me, interesting, challenging, difficult things that you've experienced in life and overcome. And that could be across the gamut. That could be people overcoming adversity that they had absolutely no control over, right? Coming out of really difficult childhood situation or coming out of poverty or whatever. Or it could be something that people chose to do. Say like, well, I decided that I wanted to do this and I spent 3 years just grinding and figuring it out until I accomplished it. So looking for that, and I can work off of that.
Okay. So when you have that person, they come in, they present, you're probably in talks with them before they come in and you have meetings, right? Like they submit a form, send an email, you weed through all that. Yeah. They come in, you have a sit down meeting with one or more partners.
Yeah.
What's the decision look like? The person leaves. How is this decision being made? What kind of things are you guys discussing? I mean, obviously you're discussing, of course, the track record as you just mentioned. Anything else? Like what's this meeting look like if you're talking to your partner?
It's usually it's a broader team. So all of our directors, everyone who's interacted with the founder has a voice in this conversation, which I think adds a lot of perspective to what we're doing, especially more and more so I find like a lot of our younger staff have a lot of perspectives on, you're starting to see a lot of Gen Z founders. And I always love to put the impetus on them and say like, before I say anything, I want to know how you feel about this because, for better or worse, you and I are now, we're the Gen X to our millennial, right? Like when we were millennials and we were cool and we were shaking things up and you look at Gen X, you're like, oh, these are all the like boring 30 and 40 year olds that have houses. We're now that generation. And so I always feel, looping in our younger people and sort of deputizing them to say like, I want you to have an opinion about this. Like, I don't culturally understand what they're talking. I can look at what they're talking about through a business lens, but when they say people are doing this and that, I don't know. That's not me. That doesn't represent me. I would never do what they're talking about. So I want to hear your opinion on it. So we generally have a conversation around the team and I try to guide people around those specific things, which is how do we feel about team product fit? And they don't have to have a product, but they need to have a vision of what they want to build. So how do we feel about sort of their passion for the project? I think a really easy shortcut for me to weed out founders is why do you want to build this company? And to me, the best answer is because I just can't sleep at night knowing that this problem isn't solved. Like they're just incredibly focused and obsessed with the problem they're trying to fix. The worst answer is and people never say this, but you can sort of peel through the onion or read between the lines, say that, they just picked up whatever was hot on the internet and they want to be a founder and they want to be rich and wealthy and all the things that come with that.
And some of those people may pull it off, but less.
They may, but I think like if you invest over a long enough period of time, they're sort of disproportionate, like net, that cohort of founders is going to lose money for you.
That makes sense.
And I don't think it's a good reason to back somebody, right? Like investors aren't backing founders
so that
they can become it's like, well, why should I back you? And if you walked into a VC meeting and say, why should I back you? Like, because I want to be rich, right? Like you get laughed out of the room. And so people come up with all sorts of ways to explain around that. We're like, oh, I think this is so hot right now, blah, blah, blah. So that's a big one that I always frame and we discuss about is like, how do we feel about the motivation and sort of obsession of this founder with this problem? Because it's also a problem they're going to have to spend a really long time with.
So you'd want them to present more of their passion before they start talking about numbers.
Well, usually like we don't talk about numbers because they don't have any.
Yeah. Okay.
So it's like getting into the quantitative stuff at the stage that we invest is I would say misleading at best and sort of damaging at worst. Like it's all going to be made up. If I ask you to come up with numbers, you're just going to make them up.
Yeah. Like I didn't know if like you want to know like how big is the market for their product, all,
for sure.
Those kinds of things. But yeah, they're still fairly loose even knowing those. Yeah.
Yeah. And so what we're currently working on doing a better job of as a firm is understanding and having very well thought out ideas of the areas that we are interested in. So that's like one big initiative that I'm working on right now is like, we see founders across the board building all sorts of different kinds of things. And so what we're working on right now to really step up Antler here is to say, if we try to do everything for everybody, the level of service and quality and the value that we're going to bring to our portfolio companies is not going to be maximized. And so can we pick certain areas? And those areas can change and evolve over time, but can we pick certain areas and already have an opinion about how we feel about that market and the competition, et cetera, so that we can screen and say, okay, right now we're focused on financial inclusion. That's a thesis that we're super focused on. So we can screen out and just look for founders who are doing that. And obviously we can guide that by doing marketing and making people aware that like, this is the type of stuff we're looking for right now.
I was going to say, it's a bit of a bummer for some people coming in there though, because they might have something that they think is great. It could be great, but you're looking at a particular direction right now. So they're just going to get weeded out.
For sure. And and I think like, it's always this balancing act of like, yes, we could miss out on some great opportunities by doing that every once in a while, but we're going to add so much more value to the founders that we do work with.
Because you're going to have more expertise.
Yeah, if we're knowledgeable and aware and have opinions about the space. And then for us, instead of each team, so one of the challenges is like, all right, I meet a founder who's building a beauty brand, and then I meet a founder and she's building a AI software for lawyers. And then I meet a founder who's building an electric car company or whatever. It's impossible for me to context switch and add a ton of value for all of those different founders because they need someone who understands their different markets. They need someone who understands the competitive environment. They need someone who has a network and can make connections in the areas that are going to be important for them. And so I think the trade-off, and this is what we're going through right now, I think the trade-off to say, here's what we're focused on right now. We're going to bring in really strong founders, and then we are going to sort of weed them out. And so to your question is what it helps us do is right now, if I meet those three founders, I'm going to get really distracted by trying to figure out my opinion about those business models and spend less time focusing on how I feel about the founding team, which I think is the real key to unlocking this. If I say we're going to do an electric car sprint and I already have my opinion about how I feel about electric cars and where there are opportunities, what are some of the pitfalls, et cetera, then I can screen it down to electric car companies and really hyper focus on trying to find those founders who somebody else may miss because they're too early. They don't have recurring revenue yet, this, that, or whatever, and say, I want to take a bet on you because I think you guys are a fantastic team. And that's where I think we can unlock kind of the final piece of that's the part of venture investing that hasn't been institutionalized is how do you at scale invest in people that have almost don't have a business.
It seems like the riskiest section.
Well, risk in an investment scenario is priced. And so my thesis is from a price risk perspective, it's actually not.
Oh, okay.
Right? Because
how much equity are you getting when you write that check to them?
So we usually take a 8 to 10% stake in a company, right? Okay. At a $2 to $4 million valuation is kind of the sweet spot. And so
to compare, let's say a company that invests later stage, how much per points are they going to take? Do you think?
So the average Series A round right now in the US in 2019 was 80 million valuation. So a Series A company, and that's the distribution of that is quite high. So, if you go out to the right to the second or third standard deviation, I mean, you have Series A rounds, which are approaching $150, $200 million, right? And so what you're essentially saying from a price risk perspective, so if I pay $2 million and somebody pays $200 million down the line, all things else equal for the same equity stake. So say I bought a 10% stake and they bought a 10% stake. You're essentially saying that Series A company is 100 times more likely to be successful than the company that I'm investing in downstream. So as venture valuations continue to increase, the risk adjustment of venture actually starts to favor. It's actually less risky to invest in early stage founders because you're not having to pay such a huge premium competing with all these other funds. And so I would venture to say that thinking that that's 100 times more likely to be successful than an early stage company, or another way to think about it is with the same amount of money, I could invest in 100 companies to that one investment that you made.
I love that. Okay.
So that's an interesting way. That's probably the best way to think about it. And so at some point, so say that gets up to 150, 200, 300, right? Where it's like, I can invest in 300 companies for every one company that you invest in. At some point, to your question about like, isn't it really risky? It actually becomes less risky, which is like, would you rather invest in 300 companies at this stage where you don't know what they're building, they don't have any traction, et cetera, or invest in one company and you've got a financial statement of 3 years of information? At some point that tips, and early stage venture arguably becomes a less risky asset class.
Okay, that makes great sense. And also, I think it'd just be more fun to invest at that stage too.
It's super fun. I mean, working with founders is great, and I'm constantly challenged and educated, and being an early stage investor is a real masterclass on your ego. If you're a late stage, so if you're a Series A growth stage investor, you're usually going to focus on something very specific, and really good investors are going to be considered experts at it. So when you meet a team, they're probably fairly deferent to the experience that you have and what you can bring to the table and the network that you can bring in, et cetera. At the early stage, because you're covering so much, et cetera, it's a real test of the ego to be very humble to, in most situations, the best investments that we've ever made, the founders are always way more knowledgeable about what they're building than I am. And my job is to actually help build infrastructure around them so that they can focus on doing that piece and not get distracted by all the other things it takes to start a company. So I'll help them raise money. I'll help them fill the gaps in the team that they don't have, help them recruit, help them build an advisory board, et cetera, so that they can spend the maximum amount of time on building their product. And so it's constantly like having to remind myself, and the same thing when I was talking about with like the Gen Z is like, I constantly have to remind myself that like, I don't have a worthwhile opinion on this, which is like a really hard thing to say in like the investor culture. Cause we have this, cliche of like, all these VCs, they're masters of the universe and they're supposed to know everything or whatever. And I sort of challenge myself of like, how many times a week can I admit, like, I don't know, like, you know better than me. And that could be a team that I'm talking to, say like, well, you guys tell me, you know better than I do. Or somebody in my team, like, one of our MBA interns, and say like, well, you tell me, you tell me, I don't know. I know what I'm good at. When this team needs to go fundraise, when they need to build their team, when they need to build their culture, when they need to set up growth and marketing, great. I'll stand up with anybody, and throw my hat in to be able to do that. Best in the world. But on all the other things, I'm more than happy to admit, like, I don't know. I'm a part of this team. Like, I'm not the one who's deciding whether this is going to be successful. I'm just making a decision. Do I want to join this team and be a part of it? So, yeah, but the, 100 shots to 1 shot, I think, is a great way to think about the risk of investing in early companies.
I like it.